Thanks for joining me, Jeff.
Hey, Steve. Thanks for having me again.
Well, we've got an interesting story here. There's a lawsuit or lawsuits in the works that could potentially change how people buy properties. Currently, in order to list a house for sale on the multiple listing services, which is really a necessity, you have to agree to pay a real estate agent about a 6% commission. She'll split equally with the agent for the buyer. Your agent keeps 3%. She pays the other 3% to the buyer's agent. The lawsuits are finally coming to a head after several years, and if the plaintiffs succeed, they could rewrite those rules. The seller might no longer pay out the agent's commissions after the sales close. Instead, the buyer would pay that agent directly. The first case to reach trial will be Sitzer versus NAR, which was filed in Missouri. That's scheduled for an October trial. Total damages there could reach $4 billion. The larger of the two cases, Morel, also versus NAR, damages could total more than 40 billion. That case was filed in Illinois. That could reach trial in the first half of 2024. The plaintiffs in these cases are taking aim at the rules that they say hinder negotiations over compensation. Their primary goal is to decouple the commissions paid to the buyer's agent and the seller's agent. If buyers have to pay out of pocket for those agents, those buyer agents, we could be looking at a world where they simply choose not to have an agent to purchase the property. They might try to pay less. They might try to pay hourly rates. But if these cases succeed, we could see the end of compensation automatically going to the buyer's agent. It seems like potentially a pretty big change in terms of how homes are purchased. What are your thoughts, Jeff?
Look, I think there's probably a lot of unintended consequences. To me, maybe there's even some lack of information that people and it's really kind of what I mean by unintended consequences, that lack of information people have considered. I think if you look at it from a residential side purely, there's a lot of real estate agents that are out there that represent people that aren't already doing this full time. This is a second job. Although they may not be full time doing it, they do have a good knowledge base of how to navigate through the real estate contract, how to navigate through the process of closing. I think you're going to see some buyers that are going to try to do this themselves, so that they're not, they're already cash strapped. They're not trying to, spend more money. A lot of them are doing, HUD financing. They're doing 3% downs. They're not putting 20% down, so they're not sitting on cash to be able to pay an agent a fee to close this for them. And I think on the seller's side, realistically, and I'm not arguing one way or the other for this, I guess, to clarify, but I think from the seller's side, they should probably consider the fact that now that you have a streamlined process, you may not have such a streamlined process before. You may have hiccups because, again, buyers are going to try to navigate this through themselves. And they don't really know what to look for, don't know anything about addendums. They're already not paying attention to due diligence periods, to closing periods, days when they need to get stuff done. I think the process gets muddied and becomes a lot difficult to navigate. While I can appreciate the side of a seller not, or these plaintiffs not really wanting to pay out fees for everybody else, I think the long run is that it probably helps the process in opposition to the alternative, which is hindering the process and slowing closings down and creating more problems, more lawsuits that will come out of this as a result.
Yeah, I kind of agree. I think the case seems to have merit. I understand the idea of giving people options of not forcing them into a situation where they have to pay commissions to the buyers, brokers. That all seems to legally make sense. But I think where we ultimately end up here is that probably a few people trying to cut corners are going to end up with more trouble than it was worth trying to cut those corners. And I believe in capitalism. I think they should have the ability and the right to do that. But we both have been around the business, in the business, and I think good brokers generally earn their compensation,
Oh, for sure.
earn their fees, and there will be a cost to most transactions. I mean, certainly there's some transactions Um, some cases where somebody knows exactly what they're buying, why they're buying, and it doesn't make sense for them to pay that rate or whatnot. I'm sure there's going to be some cases where it's definitely a benefit, but I suspect there's going to be if these lawsuits succeed, and it's opened up more. I think we're probably going to see more instances where people end up shooting themselves in the foot
Oh, for
than they
sure.
do. Yeah.
Yeah, I mean, I think the other side too is if moving to commercial, if you look at it, um, there's a number of firms that claim exclusivity, and they are saying that they're not going to pay buyer's agent a fee. In the commercial world, that I don't want to say there's precedent that that's there. I mean, there is, but the truth is sometimes to close a deal, those brokers that are claiming exclusivity are also splitting the fee that they have to get a deal done, because they don't want to deal directly with with the buyer and and specifically there's a line of trust that they want to make sure that they're not breaching for both sides, both seller and buyer side. So I think there's some consideration that needs to be given to it. The learning curve for buyers without agents, and in the learning curve for sellers without buyers having an agent. You know,
So you don't necessarily expect this to have too big of an impact on the commercial world because we already see these issues kind of dealt with in a way right now.
yeah, I mean to some degree. I don't want to say precedent's been set, but there are, again, you've got the CBREs and some of the other big firms who just will tell you we're not splitting a fee, we're exclusive, and buyer's going to do it. I think alternatively, that comment is it's already well known that if a seller is requiring that, then there might be some sort of accommodation that they give up for the price. Maybe the price gets reduced a little bit so that a buyer can afford to pay the seller. Um, you know, I think the other side is the unintended consequence just dawned on me is on the residential, you're going to have to figure out, you're going to get buyers who are going to say, well, I'm reducing the price because I got to figure out a way to pay my realtor. Maybe I figure out if a lender is going to finance that. So, I think like I mentioned before, the cash to close requirements become a burden for buyers if they've got to pay a 3% fee that they otherwise are already paying to get their loan,
Yeah, so I think we don't expect too big of an impact on the commercial space from this. On the residential space, there certainly will be some buyers that benefit from more flexibility, but I think we're both suspicious that the bigger impact will probably be some people trying to do it themselves that really shouldn't be, and ending up with some unanticipated problems where they just probably would have been better off paying the commission.
Oh, for sure. I think that you're going to end up with a lot of failed closings and a lot of lawsuits associated with escrow, escrow disputes.
Okay, so I think that's probably our bottom line is that it turns out when it comes to major lawsuits that the one group of people that always seem to win would be the lawyers, and they'll probably do even better with things being more opened up, and we can probably expect more suits in the future if these suits are successful.
Of course, of course. It's always the
Okay,
unintended consequence.
well, I don't think anybody will argue with that conclusion. Thanks a lot.
Yeah, thanks, Steve.
We're going to be talking about real estate brokers feeling the pain of the golden handcuffs. The golden handcuffs in this case refers to a lot of homeowners have locked in mortgage rates at 2 to 3%, quite a bit different than the 6 to 7% you're looking at for a new mortgage. And in response, a lot of them are deciding they kind of like these golden handcuffs. They're going to stay pat in the house that they're in. They're not going to become a seller. They're not going to become a buyer. And we're starting to see data backing that thesis up. Realtor.com reported that in May of this year, home sales were at 406,822 in terms of home sales listed. That's down almost 23% from May of last year, and it's down over 30% from the pre-pandemic May of 2019. I'd argue this is probably a new normal that we're going to see a decent chunk of people just stay in their existing houses and keep those existing mortgage rates. What are your thoughts in terms of the impact of this and what's going on?
So, it's kind of interesting. I started taking notes as you were talking, and just some of my thoughts are, I don't know that sellers or, owners, I guess is probably a better way to put it, like it. I think it becomes a question of can they really afford to sell? Did they buy too high, and now because of interest rates, they got to sell too low? A short sale. And on the flip side of that is if they are available or able to sell, where are they going to go? What are they going to buy? Can they afford to buy? They qualified for the rate that they had before. Now they're looking for something similar to what they have in a different area. I think it might be a difficult discussion. Which brings me to the next point, which is the inventory. You're already looking at stale inventory. There's a lot of new buyer or developers that are out there building new stuff to accommodate the lack of inventory, or really stale inventory. I think the third point, before we get to the real impact, is because the interest rate, isn't that big of a deal to our generation, the generation prior. 6-7% is still kind of low to that generation. I think I and our parents remember paying 18-19%. What's 6 or 7%? So I think the real impact is to the new home buyer, and is the inventory good for them? Do they like it? And it's something they're willing to pay for.
Yeah, and
Now,
I think right, there's different markets. So markets where there's not a lot of area to develop or build are probably going to
that's
feel
right.
this a little bit more. I think that for folks in the construction industry, this actually might be a positive in that people may do more work on their existing homes rather than move and
For
to
sure.
meet some of that buyer demand. There may have to be no more new home construction done. But I would agree that this is probably a net negative for brokers. And we just also covered a story about lawsuits that may also negatively impact real estate brokers. So unfortunately, I think this is just one other development that says that things are probably going to be a little bit more difficult to be a realtor than they have been in the past. I also think, though, that this is also another one of those things is a bit more of a residential story than a commercial story.
Yeah, for sure. I'd add, the negative impact to brokers. Transaction volume is clearly going to go down. The other stories that we covered, you're already talking about an industry that, on average, at least in the state of Florida, on average, the average broker sells 2 to 4 properties a year. That becomes a question of, now that there's not as many buyers, does that number go way down dramatically? Does it become, 1 or less than 1? At that point, what does it actually cover your cost to maintain your license and continuing education? So, yeah, I think it definitely impacts the brokerage world.
Yeah, thanks a lot. We're going to be talking about a recent transaction in New York around a high value office property. This was New York's largest office landlord announced that it had sold an almost 50% interest in 245 Park Avenue at a gross asset valuation of $2 billion. They mentioned that they're seeing strong demand from tenants and investors for high quality office properties located in highly commutable areas. An analyst noted from Barclays that this was an unambiguously positive signal for well-located, high-quality office assets like 245 Park. This represented the transaction price a slight discount that was paid to acquire the building in 2017. But so we're really seeing in this case a office property that is characterized as being very high quality, a premier location, very commutable, as having actually held up in its value pretty well, despite all the very negative stories we've been hearing about office.
Yeah. Anecdotally, I'd tell you, I recently had a conversation with a banker who tried to tell me that office is a dead asset class, which I laughed and couldn't help but correct him and say it's not dead, it's just changed some. In the mind of Main Street and the banks, because of COVID, they think it's somehow radically changed. It hasn't radically changed. Large corporations are requiring their employees come back to the office. They've got to have somewhere to go. They've got to have space to spread out, space to accommodate their employees, because they need their efficiency. So yeah, I mean, I think this is a pretty good indicator that office, and I don't want to say that all office in all areas is the greatest asset. It's not. But I can say that office that's well located, easily or able to be commuted to easily, that can suit what tenants needs and has the amenities is still a good investment. It's not dead. It's just changing.
Yeah, I think also when we talk about our portfolio, we acquired office in Miami. We acquired office in Savannah. Those are metros that are doing very well. And unfortunately, I think after '08, people started thinking about real estate as almost this monolithic asset class across everything, just because you saw a really abnormal synchronization, and it just isn't. That's not normal. We're seeing different classes perform differently. We're seeing different metros perform differently, and I think while it's an easy story to write of there's blood in the streets and everything's a disaster and office is horrible and it's never coming back. It's a gross oversimplification.
Yeah.
There's certainly metros and categories that are really having problems, and we're going to separately be talking about a news story about San Francisco, which really is having some pretty serious problems. But I think this example from New York is a metro that, despite having some struggles, this is an example that some types of office are holding up really well, and kind of goes to your point that the not everything has changed. Employees are still going to the office. Major corporations are still
Right.
expecting them to be there. Um, so, I think
Well,
this is
you're being nice. Expecting is a nice way of saying demanding that they be
yeah,
there.
yeah.
And let's the other side too is back to offices and debt. It's changing. Is the prospect of there's only so many large corporations that need extensively large space. There's a lot of small businesses, and this country is still made up of a lot of small businesses that need space, need places to operate out of.
So I think this just kind of goes to, while journalists can kind of paint things with a very broad brush and manage to sell articles or clicks or whatever. As an investor, you're going to have to be much more meticulous, and you're going to have to actually look at what's the metro, what's the class, what's the individual building. You're going to have to do all that work because not everything is just going to be correlated and go in the same direction. You're going to see what we're seeing here of, a market like a Miami doing very well, a market like New York in certain categories showing stabilizations, and then San Francisco right now would be an example of a market that just seems to be imploding at the moment. But you really have to look at things on a case by case basis, and not just say COVID came, remote work came, and now office is no longer investable. It is just untrue.
Well, and just to add one other side, because you mentioned San Francisco, municipal regulations and implications have a tendency to cause investors to go the opposite way. They're looking for a good investment, not somebody that's going to come in and take their investment away from them because of regulation.
This is actually not the first time we'll be touching this particular topic of San Francisco real estate. We just saw another property there sell well below its expected price. This was uh, development firm Ellis Partners and equity partner Bupes Group are purchasing 180 Howard for about 62 million. That building was expected to sell for 85 million, so not quite a haircut, more of a decapitation there. Um, this is the third downtown building to trade at far less than its value. 350 California Street reportedly sold for about 75% less than its previously estimated value in May. Um, and we've also recently seen the largest mall there close, two of the largest hotels basically return the keys to the bank. Whether it's office, retail, hospitality, we're just seeing downtown San Francisco really. I don't know if I want to call it a doom loop, but it definitely seems to be the worst commercial real estate market in the country right now, while other markets, we just talked about New York showing some stability with a good price transaction there. It just doesn't seem like there's any good news coming out of San Francisco, and this is just the latest blow.
Well, I mean, San Francisco seems to be the easiest punching bag to punch at these days. Um, it doesn't help that you've got a lot of government regulation in there that's helping keep investors out, keep businesses out, not managing the bad stuff that your so-called civilized population is currently doing, keeps people from wanting to be there. So, and I think, I recently read an article that indicated that, San Francisco themselves, recognize that they needed new developers to come in and develop new properties, and that they were potentially looking at deregulation to allow that to accommodate good investments into the market.
Yeah, I think that's a positive sign. I mean, I do think that the big plus you have for San Francisco is it's some of the most beautiful real estate on the planet.
Not that
Um,
you're biased or anything, so
well, yeah, I might have a bias, living here. Um, Part of the problem though is there's also pretty nice alternative real estate, and that's one of the things you've seen happen with the economic base here is that people have moved or relocated to the peninsula, to San Jose. There are alternatives. I think one of there's a few things I think that has really hit San Francisco, and you alluded to one of them. Public policy has been one of them. Property crime is is a real problem, higher than what the numbers suggest, because it's gotten to the point where people don't even bother reporting property crime because the cops take forever to show up. They're not going to really do anything about it. So the numbers are, you have to start looking at polling data and other things to get an idea of just how bad it's gotten there. And it's not as bad in the rest of the area. They also, San Francisco had a lot of exposure to tech. It also had a lot of exposure to startups with venture funding. And as we've seen financing and capital get more constrained, the startups have been impacted. Not just that, but a lot of those startups, maybe their VC backer decides you don't need downtown San Francisco offices. You can go somewhere else. And I think they've also probably been hit by the remote work trend a little bit more. If you got a small team, especially a small team of coders, those are folks that are going to be able to work from home in a way that a doctor's office can't. So I think my personal opinion is a good chunk of this is self-made damage in terms of public policy in the area, but it's also been a perfect storm of the remote trend, the COVID lockdowns, the exposure to tech, and particularly to startup companies. It's all kind of rolled together in this perfect storm where San Francisco just does seem to be, uniquely doing about the worst of any metro area.
I think you hit something, and I hate to say maybe, but it really is kind of a maybe. Even for coders, coders sitting together, being able to um, coordinate and work together is something that creates an efficiency factor for those industries, companies, et cetera. I think the other side is, some of those VCs are probably also saying, why do I need to pay $100 a square foot when I can do the same thing for 20 or 30, or 50, whatever it may be, significantly less in a different area.
Yeah, I am optimistic, like I said, that San Francisco will eventually turn this down. The point you made brought up that they're actually looking at a shifting regulatory policy. That's pretty huge for San Francisco, not something they're known for. I was
I
still,
didn't say a
although
lot. I didn't
no,
say a lot. And I didn't say they were
yeah,
actually going to do it. They just indicated they might.
might.
So
We're going to grab onto it. I will still, although being biased, I will still argue some, one of the most beautiful locations around. Location's a hard thing to beat. I think this is something that can be turned around, but right now it sure seems like, to borrow the old Wall Street adage, that you're trying to catch a falling knife at this point if you're doing a transaction in San Francisco. It's hard to say we've seen a sign that it's bottomed yet, and this story is just the latest that sometimes no matter how bad things get, they can always get worse. And that seems to be the development this week for San Francisco is no matter how bad it's gotten, it managed to get a little bit worse in terms of the property values there.
Haven't hit rock bottom yet.
Guess not. Hopefully, it'll be a nice bounce. I've got a feeling we're gonna be continuing to mention San Francisco partly because the media loves it. They like kind of running stories about how commercial real estate is in a complete disaster, and I think you and I would argue that that's not a fair picture to paint for the broader country across asset classes. But it is a fair picture to point to of what's going on in San Francisco right now. So I think they're drawn to these stories. It is a major market, and so I think we're probably going to keep getting a few more of these stories that we'll be able to talk about. Unfortunately, for a little bit to come.